anybody that says these things around the Fed going full throttle and completing their promises and strong job market is just not doing basic mathematics of where and how
No,
much.
because people say to me, they're like, well, the Fed, to kill inflation, they need to get interest rates above the rate of inflation. I'm like, are you fucking kidding me?
Impossible. You could do it in the 60s. You could do it in the 70s, even the 80s. You can't do it now.
Larry McDonald, as ever, an honor and a pleasure. How are you, my friend?
Good, pal. It's been too long, but we've been consistent over the years. So every year it's 2 or 3 times. And the last time we made, I think both of us made a nice call on the net present value and future cash flows with NASDAQ equities, right?
That's right. So look, it's always fun to pick your brains on what's going on. You've got some big thoughts out there. So give me, to start with, your framing of where we are with the macro right now, because people are all over the map in this. I've never seen people so spread around. It's fascinating times. So where's your kind of base case and how are you thinking this through?
Well, there's no I in team, and I work with a wonderful group of people. So we have a Bloomberg chat with about 650 institutional investors in 30 countries. And what we do is what's called mosaic research or application. So we'll talk about ideas during the day. It's like a live ideas dinner with the institutions, a lot of hedge funds, mutual funds, pension funds. And then we triangulate the conversation and figure out where we are relative to where we were months ago. And the feeling I get over the last 2 weeks is so much like Lehman or just before COVID, in the sense that the move we've had in rates, oil, and copper only have happened before spectacular credit events. And it's amazing how those three, and you've always said over the years, those are the big three. And but if you look at the global banking system, what's happening in Europe, what's happening in emerging markets, I think over the last 10 days, at least 7 finance ministers have called either the Treasury Department of the United States of America or the Fed. There's just tremendous pain there. And then the banking system in Europe is buckling. And at the same time, in the United States, if you do the math on crypto, equities, and bonds, you're talking about 30 trillion of wealth loss, and you got to throw housing in there now. So you're talking about just a colossal wealth destruction on top of the global systemic risk, and that wealth destruction is just from the move in bonds and the move in equities. And so those 3 things combined are going to force the Fed. The beast in the market is right about to force the Fed out of their policy path agenda.
I've got a very similar view to you. I think we've had, if we include the dollar, commodities, and rates, and the rate of change of those, probably the largest, fastest tightening in history. And to me, my forward-looking indicators make it look like economic growth is about to be pushed off a cliff. I've been using 1974 as a good guide, where the ISM went from 56 to 30 in 4 months. And that's the kind of magnitude of what I've got in front of me. I don't think it'll be as fast, but I think it's fast, which is kind of what you're picking up. Is what you're saying is, just to interpret it for people, is what you're saying is the reason these other central banks are calling the Fed and Janet Yellen is because there ain't dollars around, because the Fed is sucking liquidity out of the market, and suddenly all of the global borrowers are like, where's our dollars?
You can get for a 6-month treasury, you can get the same as you can get with a 10-year now. So this 6-month, 10-year is nearly inverted, which is great. I mean, that's classic recession, and we'll be 3 months inverted. But you're right. If you're an emerging market country, the evil thing that nobody's talking about, this is a Fed that has been talking about inequality and for a long time. And what they're doing is they're exporting inflation to very poor countries, because, as you described, when the dollar goes up, it's really all those other countries are buying oil, gas, food in dollars. And if you want to go to Chile right now, or Argentina, or Colombia, you can have the best vacation you've had in decades, because the currencies have been so penalized. And imagine being a truck driver in Chile or Brazil or Argentina. And your costs of running a business is just because the currency's gone against you and oil's gone against you. It's just putting people in the streets. And that's another reason why the finance ministers are on the phone to Mr. Powell.
So there's a theory going around that I have some sympathy for, that after the Russian situation, the Federal Reserve and the US government essentially are going to use swap lines as a weapon. We will give you dollars, but in exchange, you need to do what we say. How are you thinking through that? Because they're creating a currency crisis here. It's kind of, if we're not careful and the dollar has another 10% higher spike, we're going to create a enormous global mess. We'll come onto the banking system in a bit, but just at country level, we've got some huge problems coming if we carry on like this.
And you know what's crazy? One of the things I talked about in my book were these swap lines. I wrote this pretty famous book about Lehman Brothers. It's now, what I'm really proud of, it's in the top 20 all-time at the CFA Institute, and it's called The Colossal Failure of Common Sense. But during the Lehman crisis, they really started to experiment with these swap lines to Europe. And then during the COVID crisis, they started experimenting the swap lines to emerging markets. And to your point, and I read your posts, and I obviously watch Real Vision. You've been making this point that the amount of trade in dollars, the dollar is such a wrecking ball that the Fed is becoming the planet's central bank, and there's just so many people depend on dollars, and they're going to have to open up those swap lines again more aggressively to contain this serpent, this beast inside.
But politically, I think they're going to be a little more cautious. Do they want to give swap lines to China? No.
No.
But they might go to a Southeast Asian country like Sri Lanka, let's say, who's got a real nightmare, and say, we can help you a bit, but we're going to expect you to toe the US line on global affairs and not the Chinese line. Because we've seen that kind of with Russia using reserves as warfare. I kind of feel like that might be around here.
That's fascinating, because the US has been doing that with sanctions. Yeah, I think I think now I see where you're going. That's a great sniffer. That is the future. Whereas I don't want to say extortion, but you could politically, if you have a motive and you make the call the right way, a little nudge, you could definitely inflict some political power by those swap lines. Whereas in the past, Lehman and COVID, there was no politics around. And so the propensity to use politics around swap lines is probably exploding right about now.
So what I'm starting to think through is how similar this could be to 84, 85, where the dollar gets out of control, everybody's scrambling for dollars, playing a game of musical chairs where the Fed keeps taking away a chair, and the dollar goes much higher. So, okay, fine, you have an emerging market crisis, but I'm worried that it's also going to play into that polarization that's already going on, where China says, we don't want the dollar, enough's enough, because the dollar's not actually 87% of world trade, but 87% of world trade is denominated in dollars. So the dollar's China's problem now. And it's the same for India, it's the same for Brazil, it's the same for Russia. And if we're not careful, the dollar's demise could be caused by the strength of the dollar, which has always been my base case, that if we go up too much, people are going to have to walk away from the dollar.
And 20 years ago, the dollar wasn't used as a sanctions weapon. So one of the creeping elements into your thesis, which I think is spot on, around you should only be using the sanctions weapon on the dollar. It's a gun, it's a bullet that you should use once every decade. Our governments, both Democrat and Republican, have been using this 3, 4, 5, 6 times a decade. And when you take a hammer in the dollar and you're slamming it over the head of other counterparties around the world on the sanction side, and then you have this type of reaction, so you could just have a double barrel stimulus, or I should say incentive, on global players to try to diversify away, because the strength of the dollar, like you said, is literally sowing the seeds for its own demise. The government's using it as a weapon in terms of sanctions. And at the same time, the Fed is trying to conduct traditional monetary policy, But now there's 70 trillion of GDP outside the United States, 23 trillion in. When I was a kid, it was almost 50-50. You know, the US was a huge part of the global economy. Now the US is much smaller. So now when they try to conduct monetary policy and they're basically promising a just ridiculous amount of withdrawal of accommodation relative to the rest of the world. So the Fed's promising essentially 16 rate hikes, including, I'm talking total, including 1 trillion of quantitative tightening, whereas the Bank of Japan's doing nothing. The ECB essentially hasn't even cut yet. And so when you promise that much, that strength of the dollar wounds your global counterparties on the EM side, and that's creates so much frustration. But at the end of the day, the Fed must know this, because if they don't reverse course, and I think they will reverse course, not 100%, but like just walk it back over the next month. If they don't do that, then they blow up the global economy, and then the U.S. goes into an even worse recession.
Do you think that we're going to need another sell-off in equities to drive this? Do we need, because right now it's been kind of messing around, not been doing much for a while, and the Fed don't feel hugely under pressure because nothing's really breaking from here. How do we get to the Fed going from, yeah, it's okay, to, okay, it's not okay, and maybe we need to readjust? Because I also think a pivot's coming, whatever that means, whether it's a pause in the QT first, which is probably the likely thing, then it's a pause in the rate hikes, and then it's we'll see, and then eventually it's, oh shit, and we have to cut rates.
You know, the last 48 hours, last week there was a lot of pressure. I mean, it was our 21 Lehman, we have an index of our 21 Lehman systemic risk indicators, and they were the highest since COVID. There was tremendous pressure in the EM side and the Europe side, and you track the European banks better than anybody, you know, especially through your career. And you could see last week what they call I track senior financials. That's one of our class. I mean, you're talking about through COVID wides. You're talking about credit default swaps on Credit Suisse, a large bank, you know, in Europe that were through the COVID levels. And so those are extreme stress levels. So I hear you. Like we haven't broken in terms of the S&P. Like we're in a bear market, but we're not 40% lower. But I think there's enough stress. And what I really want to pass the message, and I'm hearing from clients in our live chat, that those stresses around the world, the fact that the curve's inverted, the fact that, you know, Elon Musk and Jamie and Zuckerberg, they're all saying essentially we're in recession, or we're going to be in one shortly. Even Goldman Sachs has changed their tune several times over the last 2 months. So at the end of the day, the Fed knows that they're not just hiking rates in a recession. They're hiking rates at 150 miles an hour very near or in a recession. So I don't think that they need equities to crash from here. I know a lot of people say that. I just think that if they talk to global leaders, if they talk to other finance ministers, the stress in the system is so spectacular relative to, you know, the last 20 years. I mean, it's right up there with the Lehmans and the COVIDs. I think that's enough to have them at least go from 150 miles an hour capital, combination withdrawal. Right now it's 150 miles an hour relative to the rest of the world, which is going at 0 miles an hour in terms of combination withdrawal. And then maybe they just take it down to 60. That's enough to get the dollar and the euro to go the other way. In other words, dollar come down, euro go up.
Yeah, I had my global macro investor roundtable here in the Cayman Islands. I don't know when it was, I think it was May. And we asked the same question because a whole bunch of people were like, okay, well, something's going to break. And after discussing it for a couple of days, the answer was the US economy. So it doesn't necessarily, I think the markets have priced in quite a lot. And I've got various indicators to say, look, there's possibility there's more downside, another 10%, but maybe not. The bond market feels at the wrong price for me. I think yields need to come a lot lower. But everything suggests to me that we were going to see this precipitous decline in ISM. So I went back and thought, okay, does that really matter? Because, you know, I use ISM a lot. And I went back to 1970. Every single time the ISM hit 50 or went through it, because sometimes it went from 52 straight to 40, 8 or 4. Every time it hit 50, the Fed cut, except one, which was 2016, where they paused. So I'm like, So there's 100% track record of this suggesting that as soon as the economy goes, and a lot of the time, people were then, the obvious question is, yeah, but inflation wasn't high then. Well, it was in 2008, it was in 2001, it was in 1974. Inflation, they were cutting when inflation was at peak. So I'm
That's
like,
right.
people think
That's right.
that inflation needs to come down. Inflation expectations need to come down, not inflation itself.
Yeah, if the Fed internally knows they have wounded inflation. I mean, 5-year forwards, break evens. The CPI data at 9.1% is history. So right now they're stuck in a what's called a false stale narrative, like stale bread. And so they were just think about the Rose Garden, the White House, and Powell was in the Oval Office maybe 3 or 4 weeks ago. He was on the Hill in terms of the Humphrey Hawkins or the annual Senate and House testimony. So he's been pitching this thing aggressively around inflation. But to your point, he knows behind the scenes, and all the Real Vision viewers have to understand this. He knows the data is turning against him, but not just a little bit, violently turning. And he also knows the wealth destruction. I mean, just Greenspan, I grew up through the Greenspan era in the business. He talked about the wealth effect. You can't destroy, $30 trillion of equities, bonds, crypto, private equity.
I looked at the global version of it. It's like 40% of global GDP has been written off in global assets.
Yes, I mean, what does that do? Like the Greenspan says, what does that do to consumption 12 to 18 months out? It crushes it because the upper 50%. If you're in Florida and you're worth $10 million, now you're essentially worth 6.5. And that person's not going to go out and really spend money the way that person would before. And then the bottom 50%, as we know, has almost no savings, right? And so they're being crushed by inflation. So the Fed, even though they're in the Rose Garden, they're in the White House, they're in the Oval Office talking this tough game on inflation, behind the scenes, the bottom line is, I can say this with the highest conviction. They are so over their skis on the recession, as you point out, that it's very easy for them to walk this thing back, especially, and I think they're going to walk it back next week.
Next week? Okay.
We'll start to.
Yeah. They've got to say something about growth, I think. And I agree. If you think of the bulge of all the wealth, it's the baby boomers. Right? They're in retirement, and because, unlike all the Europeans, the baby boomers are all in equities. So imagine how the 75-year-old feels when he looks at his equity portfolio and thinks, oh shit, I'm now 20% poorer. So do I have enough money to live on? To your point is, I need to stop spending money fast, because what happens if equities go down more?
This is all part of my next book, where it will be out within the first quarter next year. But if you do the math, they have 57 trillion of wealth is in the boomers' hands. Only 5 trillion is in the millennials' hands. So it's almost 10 to 1. And like you said, this is a group of human beings. The oldest boomer right now is 80, but the average boomer is 67, 68 next year. That person, that human being, lived through the Lehman crisis, 45% drawdown. They lived through the COVID crisis, another 45%, another 40% drawdown. But both of those times, the Fed had their back in the hole. Now we have inflation that's hanging around. It'll come down. The Fed's going to do a huge celebration when we hit 6%. It's going to be like, cool. Remember Kool and the Gang celebration in 1980? It was, you're going to see they're going to celebrate 6% round like as if it's 1% inflation, and the media is just going to pile on. And what's going to happen is they'll do this pause, and then at the end of the day, we're going to be. Because they can't wipe out the boomers, and they absolutely cannot. They cannot wipe out that kind of wealth. They have to slow it down, and then all of a sudden, inflation hangs out for the next 4 years, 3 years, at a 3 to 6%. That's what our Real Vision viewers have to be prepared for, because that requires an entirely different portfolio.
Yeah, and that's this is where the market really splits. I think everybody now agrees, okay, recession looks pretty bloody likely. Magnitude, duration, nobody knows yet, but we're all trying to figure that out. The hard puzzle is 18 months' time. My base case is inflation goes negative, but we need some factors. I understand the commodity supply story. I understand the supply chain story, but I think those are mitigated by demand destruction over a period of time. And therefore, if oil, I think oil goes to $60. Maybe I'm wrong. Maybe it goes to $80. But if it's down and stays there, then the year-on-year rate of change of oil is going to be massively negative, as is it for copper, as is it for foodstuffs. They're all the same. So there is an optical chance of getting that down. Do you get core inflation down? I don't know. People skewing wage growth, because wage growth, too many people are retired. So the people in jobs, there's less of them, essentially, because of the issue of the baby boomers. And the baby boomers don't get wage rises because they're not in the labor force. So I'm not so sure that we get that. But right now, that's not the macro game we have to worry about. The macro game we have to worry about is the next kind of 12 months where it's super interesting. Now, I want to ask you about something, because you pinged me an email about, listen, I'm a little bit worried about the banks. One of the things that I've always said about this market, and this is right in your wheelhouse, is equities, bonds, all of this stuff. It's not just investments, right? Most people think of it as investments. The average retail person, it's their investments. But you and I also understand it's collateral. And it's the collateral for the banking system. It's the collateral for everything. And you pinged me with an email saying, listen, I'm getting a little bit worried about how banks deal with this and the credit cycle. Talk me through your thesis on this. Because I think if you destroy collateral like this, you create an issue. We just saw this in crypto. Once the collateral goes down, suddenly a whole bunch of debt gets liquidated.
Exactly. What happens is when central banks are accommodative for an extended period of time, you lose price discovery. So when central banks hold rates down for every single day, they hold rates down, then they wipe out price discovery. And then what happens is the beast in the market, the serpent in the market, whether it be in crypto, whether it be in leveraged loans, whether it be in real estate, that serpent in the market will keep reaching and reaching and reaching, because the Fed draws in complacency over longer periods of time, and the ECB, same thing. And so they're artificially suppressing the cost of capital. And that, like you said, that collateral for long periods of time, people will play with that collateral in a very aggressive fashion. And that's what just happened in crypto. The move down, and all of a sudden there's some people that were playing too aggressively getting wiped out. Now, what I'm hearing, and this is so fascinating, because when I wrote my book, the Lehman failure was almost a $700 billion failure. So it was the largest bank failure and the largest corporate failure in the history of the world. And the book's now in 12 languages. So I did about 140 speeches in 16 countries over the last decade. So I met some very interesting people. And so now I have this Rolodex. And when I'm over the last 2-3 weeks, I've been getting these emails from different people. When I know there's something, when I get an email from either a message in the chat from an institutional investor in 2 to 3 different countries, and they're hearing kind of the same story, where the Fed did the stress test, they released the results in late June, and the media celebrated these results. Even Barron's, which I respect, I've been reading Barron's for years, they were like, "Oh, this is going to give the banks the green light to increase dividends," and I'm like, "Oh my God." So think about it. This is Barron's now. These aren't a bunch of idiots. These are very intelligent, the most shrewd, wise financial journalists in the world. And they were celebrating the stress test and actually talking up increasing dividends, or at least sustained dividends. And then we have 3 weeks later, this massive walk back by Jamie Dimon and all the banks. Something has happened in the last 4 weeks where the asset prices have moved so much in crypto, in bonds, in copper, in oil,
credit spreads.
Emerging market debt. And so in the old days, the way these stress tests would work, you do them once or twice a year. In a normal market, that works fine. But when you have this fierce change in asset prices in such a short period of time, somebody at the New York Fed got extremely nervous and basically wanted a retake of the stress test. And I think they did this behind the scenes. They haven't really given the results out yet, but they have forcefully asked the banks to change dividend policy. That's why the spread between what Barron's was saying and what Jamie was saying this week, Jamie Dimon, are so light years apart. And I think that speaks to what's going on. And I think it's even a darker situation in Europe, which you and I can get into.
Yeah, I mean, I've been looking at the European banks again, as ever. I mean, they're just a slow death, right? It's a slow death of the banking system. It just goes on and on and on. And they look awful. And as you say, Europe and Japan got themselves in a situation where they can never raise rates, really, whether the ECB manages to get it to zero or not, but they can't raise rates because the layer of debt's so high. So it's just impossible to raise rates. And it looks like, my view is, real rates, 5-year real rates, which are plus 50 basis points or something now, that's, if I do a log channel on my Bloomberg, it's like the top of the channel. It's like we can't get to more than here in positive rates without breaking, and we turn back down again. And the trend rate of real rates is like negative 1% because of the debt issues and demographic issues. And I think what you're picking up is that we've already hit that point where suddenly Jamie Dimon, who's like, he's a pretty smart cookie and he knows how to run his balance sheet, is saying there's issues here. Well, not issues with JP Morgan per se, but issues with the structure of the market and whether they can lend into this market or not.
Or how much stock they can buy back. So all the banks have been changing buyback plans. Somebody basically tapped them on the shoulder and said, hey guys, your dividend and capital return plans, there's two ways to return capital, dividends and buybacks. Somebody gave them a tap on the shoulder and said, this is a problem. And then, we live in a world where, the U.S. banks potentially, there's one or two of them that are potentially failing the stress test. And what I mean by that is, doesn't mean they're going to Lehman. I want to be careful when I say it. If you fail the stress test, that just means the current conditions around buybacks and dividends have to change, right? Or that it's not like saying someone's going to go bankrupt like a Lehman Brothers. But if you look at the loan books in Europe, say Commerce Bank, relative to even say Citigroup, you're talking about, and you look at loan book versus market cap of equity. Just a simple calculation: loan book versus market cap of equity. There's a 6 times differential between the Commerce banks of the world in Germany and Citigroup or the U.S. banks. And so, at the end of the day, the Fed and the ECB, I believe, are working together on a fire hose of some kind, because if the Fed continues to aggressively hike, they're just going to push this is where I think this is what I really want you to think about. I'm hearing that the European banks are extremely worried about the rate of change in the euro, because if you push the euro to say 90, because say the Fed keeps it going, you've got the gas crisis in Europe. Fed's like, okay, we're going to do 16 rate hikes, 1 trillion to QT. You push the euro to 90, you've got a massive inflation problem in the periphery now. So because the northern countries have more wealth, the southern countries are having far more of an inflation problem, and in a weaker euro, there's a lot of dollar denominated debt in Europe. So there's a systemic. We've always here's something fascinating, right? The last crisis in Europe, it was all about credit risk, whether it be Greece, whether it be Italy, it was credit risk. Now we've had 6 months of interest rate risk at the fiercest, at the sharpest, most damaging level in decades. And so you've got banks that are wounded just because of interest rate risk, interest rates up on prices down. Let's keep it simple. So the bank balance sheets, assets, if you're a bank in Italy, your interest rate's going up, your Italian bonds are going down. That's your core capital. That's your safety net. And now at the same time, because of the gas situation, because they're going into recession, they're facing credit risk and interest rate risk for the first time. So the central bankers have to do something. If they don't, they're going to create a large global, spiraling bank problems.
What do you say to the people who say, yeah, I hear you, Larry, but I'm listening to the Fed and they're saying they're just going to keep going and they're not concerned about recession? That's the pushback I get with a similar view.
It's such baloney. It's abs. Listen, when Paul Volcker, how many times do you hear people? And I don't want to be rude, right? But it's so wrong for people to throw around the Volcker name and the Fed. People you've done the math. You just alluded to it. There's 200 trillion more debt on the planet today than there was when Volcker was hiking rates aggressively. 200 trillion, and a ton of that is in dollar-denominated debt. There's 13 trillion of emerging market dollar-denominated debt. So if you're an emerging market country, you borrow $1 billion, the dollar goes against you, and your currency goes down. All of a sudden, you owe not $1 billion, $1.3 billion, and that's the case for, say, Colombia or Chile. They've had a 30% reduction in their currency in the last 40 days. So $1 billion liability is now $1.3 billion, and it's just anybody that says these things around the Fed going full throttle and completing their promises and strong job market is just not doing basic mathematics of where and how.
No, because people say to me, they're like, well, the Fed, to kill inflation, they need to get interest rates above the rate of inflation. I'm like, are you fucking kidding me?
Impossible. You could do it in the 60s. You could do it in the 70s, even the 80s. You can't do it now. The interest on the debt now, a 1%, right now, the total U.S. debt is 30 trillion, right? A 1% move, so it's 30 trillion, 1% move is $300 billion of additional interest costs. Before COVID, interest and entitlements in the United States, interest and entitlements, so that's your Social Security, Medicare, your pensions for all military personnel, and everything, your entitlements were 66% of the budget before COVID. Now you're up, and that's interest and entitlements as a percent of the budget. And now if you do that 1% up, $300 billion of extra interest costs, that wipes out the defense budget in the United States is $750 billion. That's half the defense budget. I mean, it's half of Medicare. You just can't. And the Fed puts on a show, flexing the muscles as if they're Paul Volcker. They know this math, and for some reason, I think it's because they need to jawbone tighten financial conditions. This is a big game. So what they're trying to do is jawbone as much as they can. And to your point, they have a lot of pawns out there, right? A lot of people in the media, and they will help the Fed sell our viewers at Real Vision, because I feel like I'm part of the team. They're trying to sell the viewers that they're going to do X, Y, and Z when it's mathematically unsustainable promises. It's complete baloney, and the beast in the market's going to come off of the path.
So really what they're doing is inflation expectations. What they're trying to do is say, we understand what we're going to do. If we can bring forward expectations, and there's a lot of charts now to show how far some of these expectations. I think the Bank of America survey came out, well, somebody posted on Twitter today, and from the investors, the expectation of CPIs utterly collapsed. So we're getting into that zone where the Fed get comfortable to say, well, if we brought future expectations down, then it will be transitory. Whether it is or not, we will find out.
What's amazing is they have done that with pure jawboning. They've only hiked 150 bips.
I know. So the market did it for them. And it's quite funny to me because people go, well, the Fed needs to get higher up. I'm like, no, the market did it on its own. We actually don't need the Fed. The market did all the tightening, slowed the global economy without the Fed. So, the shoe that I'm waiting to drop now is for yields to fall. And I think it's coming, whether it's from your point of view, which is maybe they're going to be softer than people expect at the next meeting, or mine is the next round of economic data, stuff like ISM and stuff like that, when it starts falling pretty sharply, the market will start sniffing out that they're going to have to do what you say maybe the month after. But it feels like we're right in the zone here.
And this is fast because we agree on so much. I think for your thesis to play out, they have to really complete a lot of the promises. And you're right, they could drive inflation to negative if they want to create a depression, right? I just think that the global pressures from other central bankers, the pressures on the wealth destruction in the United States. So every wealthy American has lost so much money, and they're calling their senators. Let's be real. the Fed has been politicized. Okay, it's over. Independent Fed is just over. And so there's been so much wealth destruction in the United States, at least 30 trillion bucks by the end of the year with real estate involved. Remember, commercial real estate and residential real estate in the United States, 65 trillion bucks, 65 trillion. And that's at least going to be cut this year on both the commercial and residential side, I think by 15%, 10%, could be 20% at the rate of change these things are falling. So the pressure on the Fed to back away is so significant. And there's two scenarios. They go full throttle, they push inflation down, they create a near depression. But most likely what they do is to stop and start over the next couple of years. And that allows inflation to hang around at a higher plane.
And what's interesting is, I agree. I think there's a lot of outcomes in this situation, which is why it's always fascinating having these conversations, because the answer is I don't know. I hear that and I give it a massive amount of credibility. The other side is my forward-looking indicator for ISM suggests it hits 30, which is like full tilt recession, but it does it really fast because of this tightening, right? It's just the tightening put forward by 2 years or whatever it is, and it just shows this, and it's been an amazing indicator. If the ISM, let's say it doesn't go as far as 30, let's say it goes down to 35, 40, I think that's enough to lower prices. So if you say, well, real estate's going to come down, we're already seeing the home builders coming down, we're already seeing copper coming down, we're already seeing Baltic freight, we're seeing, in fact, all commodity complex. Oil's still a bit sticky, but it's come down. So that's the last shoe to drop. Wages are always lagging. Owner's equivalent rents are always lagging. But if property prices are coming down, they're coming down. So I'm like, well, where is this inflation going to get generated from?
Well, okay. If you take the 2014 plane of CapEx, say right where we were January 1st, 2014, of metals, mining, and oil. So oil, gas, and metals, to keep it simple. Oil, gas, and metals, global CapEx, and you moved it forward at the same rate it was on January 1st, 2014 to today, we would have about $3 trillion, maybe $2.8 trillion of capital expenditures that would have been made. But you've had ESG, you've had all kinds of environmental attacks. You've had, obviously, a commodity bust in 2016 that impaired a lot of oil companies, a lot of mining companies, and it basically enforced all kinds of discipline into a whole crowd of people. And so now we're $2.6 to $2.8 trillion of capital expenditures for metals, for all, copper, iron ore, obviously gold, silver, every metal you can think of, oil and gas. And guess what? The global population is about 600 to 700 million people higher. So we're near a global population of close to 8 billion. And back in 2014, we were about 7.2, 7.3. So you've got a lot more people. Now we're coming out of COVID. Let's think about what Druckenmiller and Soros have taught us, right? You want to discount the obvious and place capital in the direction of the unexpected, right? So think of where the planet's going to be a year from now. We're coming out of COVID, a lot better situation there. Europe and Russia, the war, that's been raging in terms of nat gas, and there's been no solutions. We probably get some type of resolution there over the next couple of months, and then that's in a better place. China has had this massive credit impulse shock where they've taken credit impulse down. They really haven't stimulated aggressively. They probably have to ramp that back up. The U.S., to your point, last in, last out. So a year from today, the Europe went into recession first, China slowed down first. The rest of the planet's in a lot of pain. A year from today, the dollar has to be a lot weaker because the U.S. is going to be finally showing that recession pain last. And that's what those two things combined, that huge CapEx hole relative to where we should be. That's the investments that you need for oil and gas and metals. And the fact that we should have a 70 trillion of GDP outside the United States, 23 trillion in, If the global economy stabilizes a year from now and the United States is going more into recession, then you have a much weaker dollar. And then you have more traditional 1970s, 1980s, just like higher sustained inflation.
Yeah. The argument I have with and you're actually not making this argument, but the argument I have with the supply siders is they all say, well, there's been no investment and therefore, prices will go higher, right? And I'm like, yeah, but what about demand? So what about the demand for commodities? It's going down now. You can see it's writ large over commodity markets. Now the question is okay, so there's this gap in infrastructural spending or investment spending. Does this slow period, a recession, let's assume a recession going to take another 9 months before we get to the trough, and then we need to get back and everyone needs to get their confidence back. Well, that pushes it out about 18 months before people are piling into doing this stuff. Meanwhile, that gives you more chance to solve supply problems. So that's why I don't think it's a slam dunk, because everybody thinks it's a slam dunk, but I think we're buying time. I spoke to Dwight Anderson about this, and he's like, in inflation terms, I don't think commodities won't go higher. They probably will, but will the rate of change generate inflation? And I said, where are you wrong, Dwight? He's like, it's demand. If we have a big recession, it's going to delay the whole lot. So if you think of Europe's transition to ESG, if you have a big demand shock and they've got kind of brownouts to stop power usage, well, that probably buys a year and a half, 2 years of time for the Europeans to advance further with whatever plans they want, finding gas in Algeria, plus this and that. So I don't know. For me, it's not a slam dunk, but I get the risk.
One pushback. There are two guys, two gentlemen in our live chat on Bloomberg with institutional clients that run several $1 billion in the energy space. And the one thing they've been pounding away for over a year is the ESG keystone politics in the United States around oil production has handed on a silver platter far more control of the price of oil into the hands and into the arms of MBS and the Kingdom of Saudi Arabia. And so, in other words, the last 15, 20 years, when we had a slowdown, the U.S. was pumping. So the U.S. had such an incredible energy renaissance that we were controlling the price with the Saudis, right? Now, because we've done such a massive CapEx and ESG suppression of investment, and CFOs just been burnt before. And if you're a CFO at an energy company and you watched your last three bosses make CapEx decisions and they all got shot, fired, you're just not going to make those decisions. So at the end of the day, we have handed MBS and the Kingdom of Saudi Arabia control of the price. So guess what happens? Raoul Pal's demand crisis comes in. There's a sharp recession. You know what the Saudis do? They stop pumping, Raoul. Like they don't have to pump. I'm sorry, they don't if they literally can keep the price of oil anywhere they want now. So that's why you never get to 65 this time. You get to 85 and they literally can place oil right now with a demand shock and they can place it on 85 and keep it there because they control the price.
Yeah. So give me a rundown of your outlook for markets. So we've talked a lot of macro, we've talked a lot of different scenarios. So do you think the low is in for the S&P 500 and the NASDAQ? Do you think we've got another leg lower, or this big kind of earnings shock that other people are talking about to see it down the 40, 50%? What's in your kind of mental framework you're working with right now?
Well, the last 3 or 4 days, the last couple of months, we've had a bottoming process in the biotechs. Biotechs are 36% off the lows. China equities, huge bounce. Even ARC stocks. So parts of the market have already been through an 87 crash. Worse. That's right. Yeah. Let's not kid ourselves. The indexes are in far worse shape because at the end of the day, the boomers, this is the fact that we let what I'm about to say happen. if you really do the math, technology and growth is 40%, 42%. Because what they've done is of the S&P. So if you look at the S&P, you've got consumer discretionary, which is Apple and Tesla, right? So now that's really tech. You've got obviously the tech sector, and then you have communications, which has tech companies. So you're really one big pile of technology stocks. When I was growing up in the business, materials and energy were 18% of the S&P in 1980, maybe 20. Materials were 10.
And then it became financials.
Yeah, and financials, but just materials and energy were 20% of the S&P round, 20% in 1980. Now right now, even after this huge rally, there's 6.5. So I think what happens is the market does these counter trend rallies, which is led by, obviously, we're heavily weighted on 12 stocks, and we have these rallies. The boomers are sitting there, punched in the face with Lehman, punched in the face with COVID. Powell is like wishy-washy whether he has their back or not. There's so much supply above. This time they're really going to sell. Passive investing is starting to reverse. I'm talking my best monitors of passive show me there's a drain now. And so the indexes, the S&P has these counter trend rallies. Each one will be an incredible opportunity to sell. We eventually bottom at, say, 2,800, okay, when it's all said and done. But within the market, it'll be like 1968 to 74. The market literally made 6 or 7 moves of 20 to 30% up and down for 6 years. That's what we're looking at.
So more like a market that we've seen in Europe, that kind of stuff, where it just goes sideways in a big sloppy range, doesn't get any traction. So by the sounds of it, you think the recession will be somewhat extended. If we're going to expect to see the S&P down at 3,800, that's a big, long 2002 style, 2007, 8, 9 recession. That's what you think we need to price in?
That's part of it, but it's the 67 to 70-year-old boomer with $57 trillion that just got punched with Lehman, punched with COVID, now punched with the Powell inflation fight. And, that person's just tired. And, the Harry Dent thing, I've never been a big believer in that the Harry Dent thesis because the Fed had your back, right? But if they don't kill inflation and it hangs out, the Fed's going to be wishy-washy over the next year and a half. They're going to start it up off and on. It's never going to have that clear Fed tailwind. And that gives you the 67-year-old boomers really wants their money. There's an old saying, in a bull market, you want to make money. In a bear market, you want your money back, right? And so, but let's look within the market. Silver miners right now, huge beneficiary of the move toward solar energy and electric vehicles. Hecla mining, incredibly cheap valuation at $4, $2.5 billion market cap, generating $400-500 million in EBITDA. But if the price of silver, because of the evolution of the green technology over the next 5 years, you're talking about a sector that is down substantially because the Fed's promising all of this aggressive accommodation withdrawal. So your GDX and your SIL, that's where the best risk reward is for the next 6 months because you've been annihilated in the miners. And if you buy the miners into Fed meetings the last decade, into the meeting, your returns are quite spectacular because there's always a capitulation selling process into the meeting because they're always leaking 100 bips or 75 bips or even before in the oldest. They're always leaking more than they deliver. And so your GDX and your SIL right here for the next 3 months, I think you get 20-30% returns there. And then there's your value stocks, your emerging markets. Money's going to start moving away from the United States to other parts of the world for the first time.
Once the dollar turns, right?
Yeah, once the dollar turns. But also once inflation normalizes at 3 to 6, then the entire 1968 to 80 playbook comes back where you don't want to be long growth. You want to be long value. You want to be long some emerging markets. You want to be long stocks like Intel. Intel. You've got this whole reshoring process. You guys have talked about obviously the Taiwan risk around Taiwan semiconductor. Companies have to like reshore and actually, even though it's going to cost more capital to deal with companies like Intel, which by the way, this is inflationary, right? So the whole global supply chain thing, and people having backup situations because you're worried about after the Russia war, an invasion. People like at every cocktail party in New York, they're talking about when is China going to Taiwan? Like, come on. So like you have these companies like Nvidia that are completely integrated into Taiwan and South Korea, like without any backup plan. And so Intel and the whole reshoring and this chips bill that's on the Hill this week, ACG, and we just had a call with institutional investors around the chips bill and with our partners in Washington. And it just sets up for an incredible dynamic where you got a value. So Intel has doubled its dividend over the last decade, almost, just about 90% return. So you've got a stock that's went through a huge capitulation, paying nearly 4%. You got a reshoring process, and then you've got all kinds of incredible dynamics for the business itself around Mobileye IPO coming up, and not just electric vehicles, but eventually cars that drive themselves. So in companies like Intel are in a good spot. I like it with a 4% dividend.
Bond yields.
We're going lower here. We're going lower as we.
How low do you think it goes? Because after that, you come into your secondary thesis about stickier inflation. So, 10-year rates now at 3.03 as we speak. Where do you think it goes next 6 months?
I think this time, last cycle, we went from 3, I think, to 1.4 on 10s, right? 1.6, somewhere in there. And that's from 2018 to the Powell moment in December to the crisis with, obviously, we had a crisis of Brexit and trade wars and COVID. So by 2019, we were really at the lows again, and you crushed it. I mean, before your clients and your best friend, you were sending emails well before COVID talking about a Fed funds rate much lower, especially right before COVID. You're pounding the table, and so that dynamic, I don't see it happening this time. I see a rally from 3 to 2.25. I see a Fed that gets nervous, and I see global central banks that try to bring on the fire hose and stabilize the global economy, inflation normalizing in a higher plane. And then like a year from today, you're back up. You're not at 5%, right? But you go from 3% to 2.25, and you're back a year from today at close to 3 again, maybe 3 and 4.
Yeah, but luckily the rate of change is much lower, so it's less damaging, right? It's the rate of change from coming from nothing to 3% in a very short period of time is the real damage, right?
Yes, and guess what? China's now going to be. So think of like the last 10 years. The Fed's the only game in town, right? Here, Mario Draghi's been sending people billions of dollars to pay for Italians for their energy costs, right? Germany was 5 years ago was capped in austerity. Now they're fiscaling up. So, and then China is now, they still have a lot of dollar reserves, but they just hinted around in recent weeks a $200 billion to $300 billion stimulus that's going to be financed through debt sales. So the point is, Raoul, like the whole bond bull thing to get to 1.5 again, it's in the Lacey Hunt and the Lacey, God bless them, and guys like that have been right for a long time. But at the end of the day, you have wealth destruction that's happened, and which is in the $30 trillion plus, you and I lose. So that's less bond buyers there. But you also have a dynamic around, the fact that we have so many more bonds for sale than around the planet, like substantially more. So the U.S. is not the only game in town selling bonds.
And so, final thought on this. So we now shrink the time horizon. You've laid out the case for asset prices. You think the miners do well. You think the overall markets, particularly technology, continues to struggle. You think inflation probably remains sticky, but bond yields come off for a bit. And the important message, I think, here is what you're saying is there's a lot more stress in the system than most people understand. And the probability is the Fed is going to get more dovish than people expect, sooner than people expect. And that's the
Yes,
catalyst
the
for
Fed
certain
is
things.
stuck in a stale, dry toast narrative. Think of the White House, the Rose Garden, the Oval Office, Capitol Hill. Inflation, 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 inflation. The rate of change of asset prices the last 40 days is scaring at the highest level. The Fed is extremely nervous. They're getting calls from central bankers around the world. They will flip as soon as they can. Now, they're not going to flip like they did in 2018. I'm not saying that. But when you promise the world 16 rate hikes in essentially 12 months with $1 trillion of accommodation of withdrawal through QT, and you walk that back to cut it in half or three quarters while the other central banks in the world are doing nothing, that's a substantial hit to the dollar. And then you stabilize the global economy. You lower inflation globally, because right now, at the end of the day, the Fed's just taking the U.S. inflation and sending it to Sri Lanka, sending it to Colombia. The people are in the streets, and they're blowing up civilizations around the planet. And it's just the pushback is just off the charts.
Larry, as ever, fantastic conversation. And as ever, let's see how it plays out. Interesting time. These are real macro times, right? So we love this shit.
And our book will be out next year, and I really am going to have a little dedication to you, and I hopefully you can sign.
Yeah, you better send me a signed copy. I'll be mad with you.
Okay.
All right, my friend. Great to see you as ever.
Okay. Thanks, pal. Bye-bye.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.